South Africa Business and Finance News, the 8th of July 2026. South Africa's financial landscape was dominated today by a series of major developments affecting municipalities, financial markets, banking, and the energy sector. The National Treasury has temporarily suspended July equitable share transfers to 69 municipalities, including the city of Johannesburg, over serious financial management concerns. Johannesburg alone will have 3.6 billion rand withheld after Treasury deemed its recently approved 97.1 billion rand budget unfunded, saying projected spending significantly exceeds realistic revenue expectations. The affected municipalities have until September to demonstrate that they have reduced wasteful expenditure by at least 25% if they want their funding restored. Johannesburg is also reportedly facing a severe liquidity squeeze with cash reserves under increasing pressure. The rand traded slightly weaker after the South African Reserve Bank reported a decline in the country's net foreign reserves, which fell from $73.47 billion in May to $71.34 billion at the end of June. The local currency was trading at around 16 Rand 27 cents against the US dollar, 21 Rand 72 cents to the British pound, and 18 Rand 57 cents to the euro. Meanwhile, the JSE Top 40 index opened about 0.5% lower, while the benchmark 2035 government bond yield edged higher to 8.22%. In one of the year's biggest corporate transactions, ADNOC Distribution, the retail arm of Abu Dhabi National Oil Company, has completed its acquisition of Shell's South African downstream retail business in a deal valued at approximately 16.25 billion rand, about $1 billion. The agreement transfers ownership of roughly 580 fuel stations across the country, marking Shell's exit from South Africa's retail fuel market after 124 years and giving the UAE energy giants its first major retail footprint in Africa's largest economy. Capitec co-founder has pledged Capitec shares worth approximately 6.5 billion rand as collateral to raise funding for its private investment company. The move was disclosed through recent regulatory filings and has drawn attention given the size of the share pledge. The Financial Sector Conduct Authority has also raised fresh concerns over unpaid retirement fund contributions, revealing that more than 16,000 employers collectively owe 8.33 billion rand in pension deductions that were withheld from employees but never paid into retirement funds. The shortfall affects around 590,000 workers, with late payment interest now accounting for more than 43% of the total errors. The regulator stressed that withholding these deductions is both theft and a criminal offense, with bargaining councils and municipalities accounting for the majority of the outstanding amounts. A new Boston Consulting Group report has highlighted Africa's strong banking performance, showing the continent's financial institutions delivered an average total shareholder return of 24%, narrowly outperforming the global average of 23%. While South Africa remains the continent's most mature financial market, its growth has begun to level off. East African markets are now leading the way, with Tanzania delivering a remarkable 59% total shareholder return and Kenya achieving 36% over the past 3 years, driven largely by rapid fintech innovation and digital banking expansion.